welcome to this case study. You have 30 minutes to read the question. My recommendation when you actually do enter the exam is that when you start with your question, let's say for example 7:30 in the morning, you know you have 30 minutes reading time, therefore you need to end your reading at 8 o'clock. When I include my minutes per section into my requirement, remember this will be your number of marks times 1.5, and this will be the minutes that you need to spend per section. I know that I have to start with the requirement at 8 o'clock. Therefore, I actually write this down on my page that I need to have this finished by 8:13, and I need to have part B finished by 8:55. Now, the reason why I do this, if you think about this, you know that you have only the 13.5 minutes. But every time when you look at your watch, you need to recalculate in your mind, when do you have to be finished with this section? Therefore, if you have written this down, it's easy for you to look at the time and then to look at the watch and compare how many minutes you have left. Right, so they indicate to us that this case study consists of 2 independent parts and ignore any value-added tax, VAT implications. Okay, I'm just going to ensure that the writing is in the middle of the screen. They indicate here part 1. You are employed at Client Consult, which provides accounting and tax consulting services to various clients. You have been assigned to the following clients by your senior manager. Rolling Wheels Limited. Rolling Wheels Limited is one of South Africa's biggest independent tire and fitment companies. Since its incorporation in 1965, the company evolved into a group of companies occupying numerous market-leading positions in the industry. Rolling Wheels Limited and all the companies in the group report annually on 30 June. Income taxes of Rolling Wheels Limited. When we look at case studies, remember, your standards will be incorporated, or a lot of standards will be incorporated into one question. Therefore, immediately identify that you need to know your IS 12 principles. Remember, we are reading through the information. Therefore, at this point of time, we don't know the requirement. Mrs. Zita Lewis, the accountant of Rolling Wheels Limited, calculated the deferred tax and current tax and the separate financial statements of Rolling Wheels Limited for the year ended 30 June 2019 based on the following calculations. The deferred tax balance as at 1 July 2018. Now guys, I'm not going to go into detail now in terms of every single line item. I will normally scan through this, identify that there's land, buildings, equipment, inventories, trade debtors, the allowance for expected credit losses, trade creditors, there's an assessed tax loss and unrecognized deferred tax asset. And then I will identify that they've provided me with carrying amounts, tax base, temporary difference, a rate, the deferred tax balance, and then a note. Now I will have to spend some time on my notes. Okay, so guys, what I also want you to do, but don't write this out, just briefly test your knowledge. You need to know that land, buildings, equipment will be tested in IS 16, inventories IS 2, trade debtors will be included in IFRS 9. The same with your trade creditors, IFRS 9, assessed tax loss, separate rules of IS 12, and unrecognized deferred tax asset, separate rules. Right. Then they indicate to us that they provide us with a calculation of the deferred tax balance as at 30 June 2019. Therefore, we are able to identify that they provide us with a closing balance for 20.18, which will be our opening balance, and then they provide us with a closing balance for 20.19. Why is this important to us? Remember, when we calculate our current tax, we need to calculate the movement in terms of our temporary difference. And the portion relating to our profit and loss will be included in our current tax. Then there can be a portion relating to RCI, and there can be a portion in terms of our assessed losses. Right, again, briefly look at the line items. We have land, buildings, equipment, inventories, a new one, non-current assets held for sale. Level 1, guys, please don't freak out. When you look at the solution, there is sufficient marks if you skip this section. Okay. Trade debtors, gross carrying amount, our allowance for expected credit losses. We have a prepaid insurance, trade creditors, and a provision for severance packages. Again, guys, you know non-current assets held for sale relates to IFRS 5. When we look at this, provision relates to IS 37. When you look at the heading of your table, we have carrying amounts, tax bases, temporary differences, rates, deferred tax balance, and again the note. At the bottom of your table, we are able to identify that we have an assessed tax loss. Then they provide us with the calculation of our current tax expense for 30 June 2019. And at the bottom, our tax rate recon for the year ended 30 June 2019. Again, guys, I don't want to spend too much time on this, but if you do still have some reading time available, just look at this briefly, identify how did they perform these calculations. Now, when we look at our current tax expense table, we have to include our movement as per our deferred tax calculation. Therefore, this will be the 730. When you look at the middle of your screen, our 730 temporary difference as per our deferred tax calculation for 20.19 minus our temporary difference on 1 July 20.18. Therefore, the 730 minus 0, they have included, right? And when we look at this, they provide us with an accounting profit. Important, this is a profit before tax, dividends received. We have our movement. Now remember, in our current tax expense, this movement should only be our profit and loss. We have our assessed tax loss for the year of 106. Therefore, the current tax expense is 0. Our deferred tax expense, we have a closing balance of 167 minus our opening balance. Again, when you look at the deferred tax calculation, closing balance 167 minus the opening balance 0. Then we have a total income tax expense for the year recognized in profit or loss of 167. Then they provide us with our tax rate recon. In terms of the tax rate recon, we have our 106, our assessed tax loss, on our accounting profit of 1521. Statutory tax rate, we have the dividends, the amount of 897 on our accounting profit times the 28%. Okay, let's move on. Notes. Now this is our important section. They indicate to us the land carried in accordance with the revaluation model was acquired 5 years ago at an original cost of 975,000. The only occupied building are situated on this land. Now we know immediately when you look at land, if there's a revaluation on surplus portion, that portion will be recognized in our OCI. Therefore, the tax should also be recognized in our OCI. And we need to remember that portion will be taxed based on our CGT rate. Note 2, the buildings are carried in accordance, if you just indicate buildings, in accordance with the cost model. The South African Revenue Services grants capital allowances on these buildings. 3, the equipment is carried in accordance with the cost model. The South African Revenue Service grants capital allowances on all equipment. 4, inventories are carried at the lower of cost or net realizable value. We know that this is our rules in terms of IS2. 5, During the financial year ended 30 June 2019, various items of used equipment, important that this is the equipment, with a cost of 1105,000 were reclassified as non-current assets held for sale. The sale is expected to occur between 31 December 20.9 before 31 December 20.19. We know that this is our IFRS 5 item. Okay, so guys, when we look at this one, let's just quickly identify where this 1105 is included. In our deferred tax calculation, our non-current assets held for sale, the tax base 1105, right? Now they've indicated to us that this is the cost. Doesn't look right though, hey guys? Okay, but let's move on. We don't know the requirement. 6. The gross trade receivables relate to outstanding amounts on credit sales. The gross trade receivables do not contain a significant financing component. A tax rate of 40% applies, however, not used by the entity. Now guys, why would they use this? Therefore, immediately we need to raise a question mark. Don't know the requirement yet though. Number 7, trade creditors relate to accounts payable to suppliers of goods. 8, the prepayment relates to insurance premiums for the year ending 30 June 2020. This prepayment was deductible when paid in cash in accordance with the requirements of Section 23H. Because guys, you can either now identify what they've done, but again, I don't know the requirement, therefore I don't want to spend too much time on this now. Rolling Wheels underwent a restructuring towards the end of 2019 and has a constructive obligation to pay severance packages to employees that will be retrenched during the following 6 months. Such will allow a tax deduction when the severance packages are paid in cash. Therefore, this deduction will only happen in future. The cumulative assessed tax loss as at 1 July 2018 was carried forward from the prior year's tax assessment. Therefore, this is from 20.17. 11. The cumulative assessed tax loss as at 30 June 2019 was calculated as 345,100 plus the 106,000 as per our current tax calculation presented. Let's just ensure that we understand this sentence here. They indicate to us that the cumulative, therefore a cumulative will be a total amount, was calculated as the 345,100 of the opening balance. Therefore, let's identify this amount in our opening balance. The assessed tax loss in this deferred tax calculation, 345,100. Right. And then they indicate to us plus the 106 per our current tax calculation presented. Therefore, when you look at this, our current tax, the 106. Look at the table, please. 106. Right. Go. 12. Rolling Wheels Limited does not expect to generate any taxable profits in the foreseeable future. Therefore, guys, remember, then they cannot recognize a deferred tax asset. If they don't expect any profits in the future, they cannot recognize that deferred tax asset. The tax rate on companies is currently 28% and 80% of capital gains is included in the taxable income. 2. Inventory of Alloy Wheels Limited. Alloy Wheels Limited is a subsidiary of Rolling Wheels Limited. Right. Guys, I prefer to indicate with colors which company I am currently busy with, which manufactures automotive parts that it sells to the public. Mrs. Haiku processed certain entries in the records of Alloy Wheels Limited for the financial year ended 30 June 2019, but is uncertain whether these are correct. Alloy Wheels Limited uses a perpetual inventory system. Now, what is a perpetual inventory system? This records the sales and purchase transactions immediately. Therefore, as it happens, it will be recorded. And the specific identification cost flow method to determine the cost of all of its inventories. Raw materials for the current year purchased at a total purchase price of 12350,000. Therefore, immediately when we look at this raw materials and we look at the nature of this entity, we need to identify IS2, our keyword, the inventory system, raw materials. And they indicate to us purchased the total price of 12.3 million, and then an early settlement discount of 2.5% is granted by the supplier if invoices are paid within 30 days. 4% of the raw materials, mainly steel and other metals, is wasted during the production process due to offcuts. This is considered a normal part of the production process and unavoidable. Therefore, the first question that I do raise is in terms of our settlement discount of 2.5%, you need to know immediately that this will not be included in the cost of your raw materials. Then, in terms of the 4% wasted material, this is normal. Therefore, due to the fact that this is normal, this is included. But if this were abnormal, we had to take this out. Right. Then they indicate to us Alloy Wheels Limited settles all purchase invoices strictly within 30 days. 85% of the raw material purchases for the year were paid in cash, while the remaining 15% will be paid during July 2019. Mrs. Heike processed the following journal relating to the purchase transaction. She debits the raw materials inventory by making use of the total 12,350,000 times 96%. Now guys, this doesn't look right, because what she does here is she actually takes out the normal wastage. But as per our rules of IS2, this should be included. And then she recognizes the normal wastage in our profit and loss. Right? And then the second or the third line item, she credits the discount income as an income, 308,750. She credits bank and trade creditors, not receivables, sorry guys, trade creditors. Okay. From 1 July 20.18 to 30 June 20.19, Alloy Wheels also rented factory space on a short-term 12-month lease at a total amount of 1,040,000 paid in cash, which is correctly regarded as a fixed overhead cost to manufacture Part 1B. Remember, fixed overhead costs should be included in the cost of our inventory. A contract administration fee of 26,000 Rand for the year was also paid to the managing agent, included in the 1,040,000. The production volume for the year was budgeted at 71,500 units of Part 1B, while the actual production volume for the year was 74,750 units. For 2 full weeks in November 20.18, production came to a standstill after unusual severe flooding conditions rendered the factory space unusable. Okay, so guys, when we look at this, we need to identify that the contract administration fee cannot be included in the cost of our inventory. We also have to identify the fact that there is unusual wastage. Therefore, this cannot be included in the cost of our inventory. Therefore, when we now look at the journal entry, Mrs. Heike processed, stating debit work in progress inventory, which is the 1,040,000. She divides this by the normal times actual, which guys is incorrect, because when you look at this, a debit here of 1,087, she pays cash the 1,040,000. Therefore, we can't recognize an additional amount here. She credits the excess production gain in profit and loss, and she credits our bank account with the actual outflow. Right, on 30 June 20.19, the only inventories still in stock was 10,000 units of finished goods with a carrying amount of 3 million. All raw materials were used in production and all work in process was completed. Okay, so when you think about this, remember now, we have our raw materials, we have WIP, and we have our finished goods. Therefore, they indicate to us here that the finished goods, the inventory at year end, is the 10,000 units with a value of 3 million. They indicate to us that all raw materials were used in production, therefore there is nothing. And they indicate to us that all work in progress was completed, therefore nothing. Then they indicate to us each unit of finished goods can be sold for 312 Rand. Alloy wheels is expected to incur 30 Rand per unit in selling costs. And then Mrs. Heike processed the following journal entry as at 30 June 20.19. And now when we look at this, guys, this is an adjustment in terms of our net realizable value, because remember, our inventory should be carried at the lower of cost or net realizable value. Let's have a look at the requirements section. Remember, your first step, you need to take the marks, part 1A, 9 marks times 1.5, and this will be 13.5 minutes. Now guys, I normally round this down. It just gives me some time to play with, or not really, half a minute. Okay, I've indicated to you why I include the time 18:30. Assume that you have started with this question. You've completed your reading time at 8 o'clock. You've started with the question 7:30. Therefore, you need to have part 1A completed by 8:13. The same principle applies with part 1B. The total number of marks will be 28 marks and your time will be 42 minutes. Therefore, you have to have this completed by 8:55. Guys, when you look at a question and you identify that the marks doesn't add up, please don't waste your time to recalculate. Just start off with a question. You don't have time to waste. Okay, let's briefly read through the requirement. Provide correcting journal entries in respect of inventories and the separate financial statements of Alloy Wheels Limited for the year ended 30 June 20.19 in accordance with International Financial Reporting Standards. Succeeding transfer journals, for example, transferring corrected raw materials to WIP, then finished goods, etc., are not required. Limit your answer only to the information and entries provided. Now, what do they mean here? Remember, when you think about your IS2 table I've provided you with, it normally starts with, we have our raw materials, we have our WIP, we have our finished goods. Then we have our opening balance, we have our closing balance, we include our purchases, fixed, variable, and so forth. And we have our transfers. Now, the transfers will be taking out our raw materials to our WIP, include, and then taking out our WIP and take this to our finished goods, include, and then take out the finished goods, and this will be recognized in our cost of sales. Therefore, they indicate to you that you do not have to perform the transfer journal entries. They indicate to us, ignore time value of money and all tax consequences. Journal narrations are not required. Okay, correcting journal entries. Then part 1B. Review the current and deferred tax calculations and the separate financial statements of Rolling Wheels Limited for the year ended 30 June 20.19 in accordance with International Financial Reporting Standards, and provide Mrs. Zia Lewis, not Limited, with review comments in which you, for one, identify all the errors and or omissions evident from the calculations. And 2, for each error, omission identified, briefly suggest with reasons, but without doing any calculations. You're not going to get marks for including calculations, guys. Please identify this. What the correct treatment should be. Theory question, guys. Therefore, very important. They want you to identify the error and then state how to correct that error, or how they actually should have included that section. Please note, you are not required to check or comment adding errors or the mathematical accuracy of the calculations. Therefore, you do not have to focus on any calculations. Limit your answer to the information provided. You are not required to discuss how the calculations should be disclosed in the financial statements. Right.